Now to the big story. The 2-year banking sector recapitalization of Nigerian banks was successfully concluded on Tuesday, the 31st of April. The Central Bank of Nigeria says in a statement released today that 33 banks have met the revised minimum capital requirement, raising nearly 5 trillion naira in fresh monies, while all local banks remain fully operational as the Central Bank implemented the program alongside an orderly exit from regulatory forbearance. Let me bring on my panel of industry professionals to discuss this and what the outlook is moving forward. Starting from our Abuja studios, welcome Professor Ken Ife, a development economist and a public policy analyst. And with me here in Lagos, Ugodre Obichukwu, founder and CEO at Nairametrics, and Nigeria's leading online financial news and analysis platform. Also, Stephen Chima, investment analyst at Cardinal Stone, a leading multi-asset investment management company based also here in Lagos. So good evening to you, gentlemen, and we thank you all for making the show tonight. Let's get started with you, Ugo there. Are there any surprises? The central bank got this exercise successfully wrapped up and within the set timeline of 24 months.
Thanks, boss. It's always a pleasure being on your program. Yeah. Surprises perhaps to those who doubted, the resilience of the economy. I think I would say I was one of those who always thought that this was possible within this 2-year period, and I think it was pretty clear. Look at the numbers. The data obviously would tell you that there was enough capital here to pull. We were looking at money supply at over 100 trillion naira. The economy, like I told some people earlier today, that this is a largely informal economy. So there's a whole lot of money out there that we need to pull. And let's understand that we are in an economy where it was important that capital formation is the cornerstone of how we want to push this economy forward. And so with the kind of reforms that was coming and with sort of adjustment that we had with the exchange rate, it was pretty obvious that there was going to be a lot of money out there in circulation. So how do you get this money out of circulation and put them in the hands of, the markets of businesses that can actually utilize it for the greater good? So I wasn't at all surprised. I thought that we're going to meet this recapitalization deadline. Now, mind you, it wasn't only banks that was raising money, right? So you also had public offers across the spectrum over the last, couple of years. FMCGs, there were a lot of commercial papers. Now, while all this was going on, you still had, fixed income securities being oversubscribed, whether it was treasury bills, whether it was OMO bills, even the government was also borrowing. So there's been a lot of capital movement over the last 2 years. So it would not surprise us at all that we're able to pull this off in 2 years. And from what the CBN is saying, 71 or 72% of the entire money pulled was local, so which is just incredible.
We're going to come to that. Incredible participation by local investors. And that's quite interesting in other jurisdictions. But Stephen, let me ask you, what are you hearing from within the banking and investment industry as the deadline expired yesterday, where there's some concerns who will make it, who will fail?
Right. Thank you very much for having me. Absolutely not. No concerns, really. I mean, I think that the sentiment around the market has been pretty positive. I remember 2 years ago when the CBN first put out this announcement, right? It was met with fears from the market particular, but I mean, the banks have been able to, over the last 2 years, just go about these capital raises, 2 series of rights issues, private placements, even public offers, and they were able to meet this recapitalization minimum capital requirement in good time, just before the 31st of March deadline yesterday. And, earlier today, we did see the circular that came out, and, pretty interesting stuff that we saw there. The 3 banks have been confirmed that as recapitalized, and the total amount raised during the entire program, 4.6 trillion naira, huge stuff there. Because I think one interesting thing to note about it is because it's the 30% that was raised from the foreign investors, right? I mean, it just speaks to the strong interest from the international investing community in the Nigerian banking sector. So pretty strong sentiments. The body language is pretty good so far.
Very interesting, gentlemen. Again, I'm going to go to Professor Ken in Abuja because the announcement or the signaling was in November of 2023. Yeah. That was when we just did election. Yeah. in February. Yeah. The new government came in June, isn't it? And then you've had the fuel subsidy removal, and then the whole rejigging at the central bank and all of that. So let me ask Professor Ken Ife in Abuja. Give me your first word. The central bank issued a statement today that recapitalization is done and dusted. What's your take? Good evening.
I think they've done well, actually, because if you take a historical view of 1993, when we deregulated the banking industry, and then from that 1993, in fact, from 1993 to today, the banking sector have brought in not less than $150 billion into our economy. But what happened was that in 2020, in 2004, 2005, Soludo, then the CBN governor, went to South Africa and saw that Standard, one bank there, had even more capitalization than the 83 banks that we had. And then he said, no, they're going to have to, because $2 billion naira was their capital. The capital base was only 2 billion naira. And their single obligor limit was so small, so they can't even lend. If you wanted a $20 million project, over 10 banks will come and crowd to contribute. No, so they went for that. 25 billion was the benchmark. And then they don't incentivize tier 1 banks and say, look, if you can voluntarily go up to 100 billion, then we will give you $500 million of our reserves to manage. So that incentive forced the tier 1 banks to jump to 100 billion naira. So but the rest of them, 23 of them, they were 25 actually altogether. They did 25 billion naira. Now, what happened was that once you raise that money, the second issue is, what do you do with the money? Where do you invest the money? So they also started investing in the oil and gas sector and in the energy sector, and they were very reckless because they were under pressure to make money. In fact, there was even something that Cardoso stopped, because during that time, there were a major issue about whether you will count reserve, but here, they explicitly said you can't count reserve. Because I remember that when the Association of Accountants were arguing with the central bank governor then. But anyway, this time round, he made it very clear it's not going to count. So at least we had a very clean sheet. So what then happened was that they started investing, and then they were incurring huge bad debts. And at the same time, about 2008, 2009, just barely 5 years, they were having to do that. And then American subprime crisis, property crisis also came in. So they were in trouble. The banks were in serious trouble. Professor, until Sanusi brought in AMCON to rescue them and put 6 trillion naira.
Professor Ken,
so some of those.
Professor Ken, if we'll get a bit to that, a bit of lessons from the Soludo's consolidation. But again, based on what we have today, based on what the central bank released, do you think that the signaling that was given in November 2023 and the 2-year deadline set in March 2024 had been successfully done by Cardoso's administration?
Absolutely, it has. No, it has, and the evidence is there, because unlike in the past, we have prudential guidelines and risk-based supervision that is very watertight. So the bank is not joking. The bank has minimum zero tolerance for financial system instability. So that is one thing that is you can be rest assured. And then they're going to come out even the forbearance, those statutory forbearance of the COVID era, they're also having to liquidate that. So we can't have it, but we have a very, very stable financial system. And if you look at the capital adequacy ratio, 10% for national banks and 15% for international banks. You look at the non-performing loans, 5%. They're all doing well. So the health of the bank is okay. And you have to respect the great work being done by the central bank.
Great. Thank you so much, Professor. I'll get back to you in just a second. We'll go to look at the key statistics. As the total capital raise just showing on the screen, the share of what was raised locally and globally. Are you surprised at what was achieved in terms of the metrics?
I'm not surprised. I mean, 4.2 trillion, or was it 4.6 trillion, roughly over $3 billion. Not surprised at all that they were able to achieve that within that period. Mind you, some banks actually did more than even the target that they were given, and then some banks even had to do extra, especially banks that were holdcos as well. And then this, from what we gather as well, this also went, strata all through the stratas, whether it's tier 1, tier 2, or all around. Most of them met their recapitalization on targets. Now, in terms of capital adequacy ratio, yes, according to the central bank, most of them also scaled through. However, let's also remember that the central bank also did push out a circular, I think, a couple of weeks ago, saying that, look, yes, we do know that banks have met recapitalization targets. We also know that a lot of banks still have issues with forbearances and bad loans, and to avoid the mistakes of the past, they were also going to be conducting recurring stress test just to make sure that banks are sound, and because I mean the lessons to be learned from the past, right? Because there's something that happens when you have a lot of capital and you're awash with cash. You tend to want to lend a little recklessly. So you have a central bank that's a little different now, that it's more orthodox in terms of how it's conducting its policy. So you're going to expect a lot of all those toughness and stress testing for banks. So no surprises, except like I said earlier, for those who didn't see this coming at all. And then the key thing, the next step now, which I guess you're probably going to come to next, is what next?
What's next? That's the money gap. Very interesting. Let me ask Stephen about drill down a little bit for me into what was achieved. According to the statement released today by the central bank, and that's been flashing on the screen, give me your thoughts around the key objectives which the central bank set out back in 2 years ago, around March or so, when the central bank governor says we want a system that is very resilient and what have you. Do you think this has been achieved now with this program?
Yes. So, I think the objective from the central bank has been pretty clear. The central bank is pushing for, a strong financial system, one that is resilient, one that is well capitalized to absorb potential economic shocks, right? And this just ties finally to the push for the $1 trillion economy in Nigeria. And I think that this also ties finally to, the gradual transition from the Basel II to Basel III regulatory framework for these banks, right? The Basel III regulatory framework now extends towards the, stronger capital quality, limited leverage for these banks, and stronger liquidity buffers for these banks. So it's been a great one so far from the recapitalization program. I think the objective has been pretty met.
But okay, so I'm just going to put that back. We'll put that. My team will put that back on the screen in terms of what the 33 banks make to the revised minimum capital. That's what the central bank said. Sustained confidence in the banking sector. Small number of banks remain subject to what the central bank called ongoing regulatory and judicial processes. I'm sure we don't have an idea of what those numbers really are. In terms of that. But all the banks remain fully operational. There was nothing really systemic during the last 2 years. Isn't that surprising to you, Professor Ken Ife in Abuja Studios?
Well, the fact of the matter is, in fact, I even tried as much as possible to encourage central bank to allow those tier 1 banks to do 1 trillion. If they could do it, let them do it and incentivize them. It may not be $500 million, maybe about $100 million something, but because the more the merrier. The total thing raised is $3.35 billion. But when you look at the size of infrastructure that we are looking at, funding railway line, funding power, it will take the money. So, and then don't forget that 45% of that money is going to be sequestered by the bank anyway, with a 45% cash reserve ratio. So it's not too much, it's not too big, but the real test is how much would they support the $1 trillion economy. If they go the way of spending this money to finance cheap imports that will overheat our economy and raise the inflation again, or they use this money for round tripping, forex round tripping. If they don't go for real sector to support export-led growth strategy, and then make sure they support manufacturing and all that, then it's just going to be of less benefit to the country at this moment.
Okay, so that's part of where we're going in this conversation. So we've got quite some ground to cover. Ugo, let me come back to you. In terms of the money that came in from local and foreign investors, locally, there's so much money in the system. But when you look at foreign investors, in terms of bringing about 25% or thereabout, or 27% of the money in, that's quite strong.
Yeah, pretty strong.
Considering the shock to the reforms that we had 2023, 2024.
Yeah, pretty strong. And I actually think probably would have been more if it wasn't that this was timed immediately after, just at the cusp of the reforms. Remember, a lot of foreign investors had to sit back and try to see how the reforms were panning out and see whether we could stay the course. And so there really would have been a lot of participation. And even if you look at participation in the NGX, it's still largely dominated by domestic investors compared to retail investors, probably around 80-20 at best. Yeah, ratio with domestic doing a lot more of the investing.
Yes.
So yes, you're seeing foreign participation was good, but what was more important was the sort of foreign participation that we're seeing is foreign participation from investors that already held stakes in some of these banks. And that's a very major signal, because typically when you see a central bank say, you know what, we want to raise capital, we're no longer doing 25 billion, we're going to 500 billion, and then we're not looking at retained earnings or reserves, all we're looking at is just your share capital, you would think that a lot of foreign investors will say, you know what, I'm done with this country, I'm out of here, I'm moving out. But a lot of them stayed back and actually took their positions. And you can see this in their financial statements. A lot of them still kept their position, whether it was right issue, whether it's public over, they actually did invest. And so that also spoke to the strength and the belief that they had in the recapitalization plans of the central bank. Now, what is also key is, now that they've gotten all this money, it's important to note that it's not that banks are going to suddenly be lending from their 4 trillion. Right, from their equity. Typically not how it works. You lend from your customer deposits. However, that just gives you enough buffer so that you can lend a bit more. But it's also important that the entire economy is de-risked for banks as well. So there's a whole lot of risk mitigation out there for banks to leverage on. So we no longer want an era where you have banks dole out money to businesses don't pay back those loans, and then you're going through protracted court cases and all that, and then the money gets written off. In some cases, they don't even get to court. Money just gets written off, and then shareholders take the brunt, and then we keep going on and on. So I think you're likely going to see a whole lot of changes, because now you want stricter prudential guidelines. Banks need to, the economy needs to be de-risked, lending needs to be de-risked for a lot of banks. You want stronger in the businesses as well. And that is why you're also seeing recapitalization happen across the economy as well. You've seen SEC with its own recapitalization plans. You've seen NICOM with its own recapitalization plans. You've seen PENCOM as well. And I think you're going to see this happen across as businesses try to be stronger, be more formal, have skill, so that they can be attractive to lending. And the economy is a little different now. Companies as well. So banks also have competition. There's commercial papers. So companies now say, okay, look, you know what? Before, we probably would go to banks for working capital. We don't need to go to banks for working capital anymore. We can just tap the commercial market. So there's a whole lot that's going to happen. It's pretty interesting, how the next few months, if not years, will be. Yeah.
Yeah, Stephen, in terms of this money that were raised and those who did hybrid public offer and right issue, who really bought? I'm sure you're in the industry, you know a whole lot about who bought into these offers and this recapitalization from a local point of view.
Well, like the circular said, 70% came from the Nigerian market. I saw PFAs buying, HNIs, even retail investors, because I remember when the campaign started, GTCO, for example, they put up the banner saying, get a slice of us, right? And, this was interesting times. This marketing strategy really got to the retail market, the younger generation as well. So a lot of retail investors also came in as well. And, of course, foreign investors, like the circular said, almost 30% coming from foreign markets. And again, like I said, it just speaks to the strong interest from the foreign markets into the Nigerian banking sector.
Confidence in the economy. Professor Ife in Abuja Studios, how much of this successful completion of the project as designed by the central bank, completed with an announcement within 24 hours saying we're done and dusted? How much confidence do you think that really brings to the overall economy of Nigeria?
No, it does. It does. Don't forget that part of the reason why we had to recapitalize was because the devaluation reduced the value or the dollar value of their capital base. So, and people were not keen in that atmosphere where you had devaluation and you had exchange rate, instability. So, and foreign investors were worried. So, but it's good news that 1/3 of them came back, but it could have been more. That notwithstanding. So the fact that they are celebrating this, they have every reason to celebrate this. It's been hitch-free. Do you remember what happened in 2005? It was brutal. People were being forced to merge and then take over, hostile takeover. Even the central bank governor himself, his father was attacked. So there were so many things. It was bitterness and rancor. But here, it was a different atmosphere. And then also, we're enjoying a period of stability in our foreign exchange reserves. And also, of course, you can see that with the windfall coming in now, we're just going to see what the government is going to do with the money. Are you going to send more money to reserve, or are you going to squander this money? What are you going to do? So it's a good moment for the bank, and they've worked really hard, strenuously hard to get to this position. So I can't hold anything back from them.
All right. Thank you so much, Professor Ken. If you gentlemen, let's take a pause for a commercial break as we move into what your outlook is, my gentlemen panelists, on the new horizon that the banking sector recapitalization presents to investors, bank customers, and the broader economy. And, of course, some lessons. We'll go back to 2025 recapitalization. We'll be right back. All right, you're welcome back to the special edition of the RS Exchange, Wednesday, 21st of April. My guest, economist Professor Ken Ife in Abuja, with nairametrics Ugodre Obichukwu and Stephen Chima of Cardinal Stone. I've been sharing their insights on the successful completion of the Nigerian banking sector recapitalization. Let's move on, starting with you, Professor Ken in Abuja. You were talking about the Soludo Central CBN's bank recapitalization exercise of 2004 and 2005. For the current exercise, just successfully concluded by the Cardoso's administration at the central bank. You gave me some of the parallels. Then, of course, what do you think the key lessons do you think the current administration are taking from that particular exercise about 21 years ago?
Well, the two key lessons. One, you saw what happened when they raised the money. It was about where they spend it and the pressure to go to the energy sector, dumped all that bad debts, insider dealing, anything and everything that can go wrong went wrong. Just at the same time, the subprime crisis hit them. Now we've come out of it. The question is, what are you going to do with that money? Where are you going to invest that money? There are two areas that are crying out. One is increasing digital inclusion in the country. We have to move informal to formal so that you can widen the tax base and widen your customer base. And then it's not the recapitalization that will take you out of business, it is the fintechs that will take you out of business. Because as a matter of fact, rather than 83 coming down to 25, now you are 25 going up to 33. It is not this recapitalization that will take them out of business. It is the fintech. Unless they start investing in a blockchain, AI, and then get investment in fintech. Who goes to the bank? I don't know who goes to the bank. Who goes to ATM? ATM don't work. So they have to invest their money very, very. And second point is, what are you going to do about the $1 trillion economy? Are you going to focus on funding real sector, put money on diversification of agenda, get manufacturing and agro processing, get those out, because the future of the 1 trillion is in Africa, in Africa trade. Are you going to sell raw material to Africans? Or are you going to be doing import-export of what? It's exacerbating the import dependency. So they're going to know the two areas that they have to put their money in. And then don't forget again that Nigeria has reached bilateral treaties with the UAE and Saudi Arabia, Brazil, those bilateral treaties and all of them carry investor protection with them. So banks have to come out to say, look, we want to do the business with you. Come and manufacture here for Africa. So they've got to come out. So it's not all this Mickey Mouse funding one trade here and then exacerbating our import dependency. They have to get up and face the challenge.
All right. So thank you, Professor Ugodre. Is the job of the central bank done and dusted? It's time to go to sleep, in a manner of speaking. But remember 2005. Then we've got a crisis. Then you got AMCON just about 10 years after, or 5 years after the capitalization of 2005. AMCON came on board in 2010. And within just 5 years of recapitalization back in 2005, as Professor said, things went... things just went, things went awry. Thank you so much for coming. So, how much more work do you think the central bank has to do now to keep an eye on this recapitalization that has been decently and successfully done without much brouhaha?
I think this is obviously not 2005. I tell a lot of people that the world has changed. Nigeria has changed as well. Things have moved on. People are a lot more informed. If you go back to 2005, what had happened then was, there wasn't really a lot of assets that banks could fund, and the easy one then was the stock market. So you had a lot of margin lending at that time, if you all recall, right? A lot of margin lending then. And then I think the next wave of crisis we saw with banks was banks essentially funding privatization, and then investment in, upstream oil and gas asset by locals as we started to indigenize a lot of things. So I think banks have learned a lot of lesson now. And if you read that CBN, statement, yeah.
In particular, what the central bank governor said.
Yeah.
Yes.
Even beyond that, they were very clear that the next thing was they're going to continue with prudential, guidelines and risk-based supervision. So that tells you that, banks are going to be constantly supervised, on a need-by-need basis. So yes, you've raised enough capital, but we're not just going to sit down there and watch you misuse that capital. I mentioned earlier that they also reissued a circular a couple of weeks ago that stress test is going to be a continuous thing for a lot of banks. You also see in CBN still employing hawkish monetary policy, even though we saw a slight rate cut in February. So that monetary policy tightening is still there. So it's not that banks can really have a lot of leeway to lend that much. But if there's what's going to happen next, I foresee banks would initially start to continue with a lot of risk-free lending, investing in short-term government securities, mobile treasury bills, bonds. That's what you're going to see banks doing. Banks also finance a lot of cross-border trade or trade financing. You see a lot of that. But I doubt that you'll see, lending at the risk lending at the rate that we saw, several years ago. Now, mind you, we have a lot of microfinance banks now who also play a lot of role in terms of taking on some of those risks that those banks. So it's a different environment that we'll find ourselves in. And banks are facing a whole lot more competition now because people now have different ways of funding projects. Apart from the fact that you see a lot of informal businesses continue to fund projects themselves from their own pocket, banks now face pressure to find ways to help these industries also fund. But at the end of the day, the job of the CBN now and the wider economy, particularly Minister of Finance, is okay. So how do we de-risk, the economy? I mentioned that earlier. Yes. For banks to lend. So, how do you lend and ensure that you can get your money back? And if you can't get your money back, what recourse do you have? Because that is essentially what moves the system forward. The CBN governor has said time and time again, no more interventions, right? Like we had before. So the central bank is not going to come and intervene in the economy. So banks are going to come and intervene in the economy. And I doubt that this central bank is going to be looking to bail out anyone. So because they've essentially taken those things off the table, you expect to see a central bank that continues with risk-based supervision and strong prudential guidelines. So their job actually just started, boss.
Just started. Stephen, look at the comment made by the central bank governor. What was said in terms of the market. And just put that back on the screen in terms of the statement from the governor. It says the capitalization program has strengthened the capital base of the banks That's good. Reinforcing resilience of the financial system, ensuring it's well positioned to support economic growth and withstand domestic and external shocks. So in terms of the size of the balance sheet of the banks, in terms of their contribution to the GDP, credit growth expansion, what are your thoughts? What do you think we should be seeing, we're looking at in the new horizon?
Well, so, I mean, when you look at the balance sheet size of these banks, I mean, take for example, the listed banks on the NGX, right? Prior to the recapitalization, right? These banks had a combined asset size of 140 trillion naira, right? And 2 years later, in 2025, these same banks now have a combined asset size of over 240 trillion naira. So, I mean, we've seen strong growth, from the industry, right? And I think in terms of outlook, right, because the recapitalization in itself, has positive implications for the economy, for investors, but in extension, customers and depositors as well. Right? With the recapitalization, it does make the financial system a lot stronger, and of course, this is very positive for depositors as well, because, I mean, deposits that now sits in these banks are now a lot more safer, right? But beyond the recapitalization in itself, I think what's even more important is how these banks will deploy this capital, right? And when we look back as during the recapitalization campaign, we look at the prospectus that these banks put out. You look at the top 3 items that these banks listed for as use of funds. The banks stated that they wanted to use this capital raise for loan creation, investments in technology to drive digital transformation, as well as regional expansion beyond Nigeria and Africa.
I love that. So it's talking about credit expansion to customers. Ugudre, what do you expect to see? A 500 billion naira bank, will the interest rates on my loan go down from 32% to 10%?
It's important to address. It's a very important question you just asked, right? But unfortunately, it doesn't work like that. So banks would so different things determine the interest rate. And the first one is the signal, which is the benchmark, which is the monetary policy rate. So where you see monetary policy rate gives you a fair idea of where you would say interest rate. So long as monetary policy rate continues to be around 27%, then lending rate would typically be way higher than that. And of course, inflation numbers also need to go down. So on the monetary policy side, you're seeing the central bank say, you know what, we have to keep fighting and bringing down inflation numbers low enough so that we can also be confident enough to cut rates, and then banks can now
create room.
To create room. So I think that we're likely going to remain in a very high interest environment for the better part of this year. And if things go right, you could probably start to see interest rates go further down towards the end of the year.
On the fiscal side or on the monetary side?
On the monetary side. Okay. Even on the fiscal side as well, because the fiscals, they're crying as well, because they're also borrowing at very high interest rates. They're borrowing at over 20%.
Yes.
So in fact, that's one thing that scares me, because on the fiscal side, you're seeing a ballooning fiscal deficit. You're seeing them even want to borrow more, but interest rates are high. So it's almost like there might be a problem down the line if they don't fix the revenue side of things. Yeah, but and then you have a central bank who's saying, you know what? This is my own turf. I'm here.
I'm going to do my job
policy.
Well.
I'm tackling inflation. You go do yours. I'm not going to come help you. Doesn't mean we don't work together, but I just want to focus on monetary policy, no more interventions. And so that is, the downside of a lot of these things. But it's going to take time, boss, for a lot of these banks to start to lend. Now, would you see some kind of competition? I think
to lend at a lower rate.
Yeah. So it all depends on the size. So if you're I don't know whether you change your name to Dangote, right? But if you're a Dangote,
$20 billion
exactly.
bank.
So you can get away with rates that are probably even lower than inflation, right? So you're wow, whatever. So you could get those kind of deals, right? I saw a video today with anybody visiting the MD of Boa Cement. So who knows, right? Exactly. So people like that, they will come and visit them.
Yes, I know. Professor Ken in Abuja, join this conversation around. At what rate would you like to see your credit at the bank, with the banks now getting a whole lot bigger with the new horizon that we have? You talk about lending to critical sectors of the economy. Do you think this is the horizon in which the government can depend on the banks and the private sector to say, look, the banks can support Dangote, can support Boa Group to complete its own refinery or any other one in the power sector?
Yeah, you see, central bank, the way central bank will behave will depend on the way these banks begin to use their money. Because if they start using their money by having to push to the expenditure side of our balance sheet, in other words, fueling more inflation, you're going to see more inflation targeting and tightening from the central bank. If they decide to embrace the real sector and add to productivity, because the way we will get out of the quagmire is to stop this import dependency. And you cannot stop it unless you have an export-led growth program. That is the only way you can do it. I'm telling you the truth, because you have to, for you to remove, if you focus on local production to meet local demand, you've missed it, because you cannot face the dumping and all these predatory measures. But if you focus on export-led growth, then you have a chance to take 400 million out of poverty as China did, 200 as India did. So the banks need to see that, find ways of supporting that. Okay, look at in the context of AFCTA, it's easy. Look what Fidelity Bank is doing. How many of them will do what Fidelity Bank is doing so that we can prioritize export and build the base? Then the second point is this. The central bank has been withdrawing from domestic finance intervention since 2023. They have to encourage central bank to come back, because when you enter into domestic finance intervention, you can get single-digit rates. So if you are going to that sector, central bank will meet you. Then these people that are bringing in their money from abroad, all these bilaterals coming in, they're coming in here to base their manufacturing in the free trade zones, and then now and all of them coming in, they're bringing dollars, they will still need currency, our own naira. So you have to actively cut these people coming in, this new investment, and then help them land and help them deliver their products to the AFCTA. So if the banks don't want to see that, it will be unfortunate, because on one hand, on the digital side, they would have been losing grounds rapidly. Then on the other side, they would have been antagonizing, and central bank will not bail any bank. From my reading of the central bank, they will not bail any bank. So what you had with Sanusi, you're not going to have it, where he had to cough out 6 trillion, and we've only got 1.5 trillion back, and all kinds of things. It's not going to happen in this administration. So, to be forewarned is to be forearmed.
Let's get back to the markets. Thank you, Professor. What's your outlook on the share price, dividend payment for this bank? Because there has to be something in return for those who brought in the billions.
Yeah, I mean, some results have been pouring in, over the last few days, audited accounts. I think you're going to see a mixed match. GTB surprised us with bountiful dividend. I mean, even though their results,
profit was.
It was pretty obvious that they were going to have strong profit. It was slightly down, but we all know why. I mean, FX from 2 years ago, but this was solid numbers. So you would see some banks disappoint with dividend, particularly banks that had forbearance issues. They might, disappoint with dividends in 2025, particularly some of the FUGAs, even some of the tier 2 banks. But for a lot of investors, I think the reward is likely going to come mid-year, half year, and then next year as well, in terms of dividend. We've seen capital appreciation happen already for a lot of investors. So people who bought a lot of all these offers 2 years ago, a year ago, bossing, they're smiling. I mean, GT, for example, the offer was it 50 naira or thereabout? Maybe 100 naira. Zenith was 50 or so. Yeah. So a lot of them, so a lot of people have already gotten their return on investment, right? So you've seen a robust capital market going up. This quarter alone, we've done 29% first quarter of the year. That, by the way, is the third best Q1 since 1985. So yeah, the best actually 2024. So it's been an interesting last 3 years.
Stephen, so what's your outlook in terms of the markets for the banks? Zenith Bank went to 103, 107 today. You think we're just getting started?
I mean, perhaps because, I mean, I think with the expanded balance sheet for these banks, I think that this would, translate to better earnings for these banks, right? And it would likely cascade to, better dividends for investors, right? We also clearly have the foreign investors are really interested in the Nigerian banks. I mean, look at Nigerian banks, they are quite relatively undervalued relative to their MEA peers, right? So, we might just see a likely re-rating of these banks, and more participation from foreign markets into the banking TCAs. Really.
Thank you so much. Give me your final word on this, Professor Ken Ife. What's your dividend looking like in the banking sector?
Sorry, I didn't get that.
Yeah, I was asking your final word for this conversation in terms of what's your outlook on dividend and share price? Are you making money? Do you see yourself making money?
Well, I'm waiting for Dangote to come to the market. Anyway, so the thing is this, I mean, it's such a momentous opportunity for the commercial banks, however you look at it. And the question is, how are they going to manage the success that they are having? And that is the big question. So we have to wait for another 1 year to see how it all starts playing out. But I wish them well.
If you're waiting for the Dangote refinery, I'm sure that means you must be sitting on a lot of money, a mountain of cash, because the Dangote refinery or petrochem is not going to come to the market cheap. Am I wrong, guys?
I mean, it depends on what you call cheap. I mean, at the end of the day, let's see what the multiples are. If the multiples are within range, single digit, then that's amazing.
All right. Thank you so much, gentlemen. It's been a great and insightful conversation with you all. Thank you so much for your time on the show tonight. Professor Ken Ife in our Abuja studios with Ugodre Obichukwu of Nairametrics and Stephen Chima of Cardinal Stone here in Lagos. A pleasant evening to all of you. Thank you so much for this conversation on the morning after recapitalization.